Welcome to the July monthly webinar from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, and as always, joined by our founder and CEO, Bob Paolucci. Bob, welcome.
Good morning, Julina.
Good morning. So this is always an exciting one for us because we are now at the midpoint of 2025. And so what we would like to do today is talk about what has transpired for the first half of the year, because what a whirlspin we've had. But then we're going to follow the traditional cadence of talking about the markets, the economy, and policy, and everything else. And I should probably share my screen at this point. So let's go ahead and do that. But Bob, anything that you would like to share on your end?
Yeah, I guess just to restate, what we were thinking at the beginning of the year. It's not on this. It's not, on any of these slides, but we'll just talk about it. We we talked about the 10-year Treasury or longer-term interest rates potentially being a barrier
Hmm.
if they remained high for the markets. That has changed, which is
Yep.
great.
Oh,
Uh,
I should probably show this slide then.
yeah, great slide to show.
Yeah.
So we talked about the 10-year Treasury. Starting the year it was high. We thought it would come down, therefore, providing some relief to the stock market. We talked about policy playing a major role this year, a combination of monetary, fiscal, and trade. So far, we have fiscal through the Big Beautiful Bill and trade, obviously, through tariffs playing out. Second half, we think monetary will dominate the headlines. We talked about regulation. This is more of a second tier item, but regulation, once the winds of fiscal and monetary and trade kind of move away, you'll have regulation, less of it, and its impact find its way into the capital markets. We
Hmm.
talked about employment. The employment picture was going to change, and it has been and will continue to. We think there will be a higher unemployment rate, therefore less employment. One of the Fed mandates, which is why we bring it up, and that will help them make the right decision. And we also reminded people that we're in a bull market and things like earnings and stock buybacks and dividends will matter, and they will likely hit new highs. So they did. We talked about the Jekyll and Hyde like approach to this year, where the first half will be pricing in change of the administration and people in key roles, titles, bills, laws, how that impacts the capital markets, the economy, so on and so forth. With the second half being usually, the winds of clarity and much more consistency blowing in. If there's one thing the capital markets like, it is a much more consistent foundation to work off of, and it is about to get it the second half of this year.
Correct.
So the title of this presentation is Summer Winds, or Summer Wind, which is a very famous song performed by Frank Sinatra. And, our take is number one, it's summer. Number two, you have the summer wind that's about to blow in, and it's about to blow out a lot of the chaos from the first half of this year. So get ready for that.
I love that title, and I think it's so pertinent to where we are right now. It's amazing to think that just a few months ago, portfolios were down for the year, and now all of a sudden we're up 5%.
Mhm.
And again, I'm going to highlight, you said in the beginning of this year that we would reach new all-time highs, and I think people were very doubtful of that. But we continue to believe in that. So let's show some reasons why.
Yeah, and actually go back to that chart for 1 second. So
Sure.
everything we talked about sort of laid out on this chart, you have the S&P 500, so the market, let's call it, is higher, new all-time highs. You have PCE inflation, which is what the Fed uses, has declined by 11.5%. You have unemployment has increased by just under 5%. You have the 10-year interest rate, 10-year Treasury, declining by about 6.5%. The 2-year rate, which is directionally getting its cues and clues from the Fed and what their policy will likely be, is down by 12%. And you
Right.
have the Fed funds rate, the thing that the Fed controls directly, unchanged. because they haven't
Correct.
cut rates. So it's
Right.
like, come on, everything has fallen into place, and everything that we had forecasted at the beginning of the year is playing out. So I think it's that final one, the Fed funds rate controlled by the Fed, that will start to play out probably in September. There's a chance in July they do something.
Yeah, and I think the listeners are going to realize as we go through this that this is the key theme, I think, for this monthly webinar.
Yeah, I'm going to go on a limb and say definitely in September they'll cut rates. There is a chance they do it in July.
Right.
Yeah.
Absolutely. So I think this is a good reminder of the volatility that we have seen so far this year, created by all of this emotion around DeepSeek, followed by the tariffs.
That's why you have to stay invested in high quality securities, stay within your asset allocation and go on vacation. Don't look at the market. And if you do that, you'll make a lot of money. If you get pulled into the day to day, month to month iterations of the market, you could see how you can lose a lot of money, right?
Absolutely.
Think about all the emotion we've had in the first half of this year and all the emotion that played out in the capital markets. You really just have to own high quality securities, buy more of them when they're much cheaper, and continue to live your life and you
Yeah.
know be happy.
And I think another way to look at these opportunities in environments of all-time highs is looking at the number of all-time highs by the S&P year by year going back to the 50s.
Yeah, when you start to hear things like all time highs, it confirms that you're in a bull market,
Hmm.
and bull markets last a long time, as we have mentioned before.
Hmm.
Bull markets typically last about 7 or 8 years, at least the modern day ones do. Um, and when you start to hear all time highs, it means there will be many more of them,
Right.
right?
Absolutely.
And
Yeah.
this chart illustrates that they come in uh, bunches
Hmm.
over a consistent period of time,
Right.
and then they go away
Yes.
for an extended period of time, and then they come back and they exist for a long period of time. And ours just started in 2024. So we think there's a heck of a lot more to come.
Bob, can I point out that President Trump's first administration back in 2016, which also had concerns around tariffs, right? If you had been hesitant to invest back then, look at all the new all-time highs you would have missed.
It's amazing. Yep.
Yep. So I would also add that for anyone concerned or skeptical maybe of our statement of new all-time highs, we have here 5 reasons, really just looking at the fundamentals as to why we think that this continues. And the first is corporate earnings.
Yeah. Corporate earnings. The stock market moves in the direction of earnings. And if that's true, then this direction looks good, which means the stock market should move up because earnings are going up.
Yep.
That's an easy one.
Yep. Then we have profit margins.
Profit margins, the percent of those earnings that companies hold on to
Mhm.
are rising.
Yep. Buybacks.
Buybacks, what companies do with their excess cash, many of them buy back their own stock, a
Yep.
great sign of corporate confidence, climbing to new highs.
Yep. And how about liquidity being a fuel?
Liquidity. So this one is through the lens of the demand for corporate bonds. And, where do these companies get all this cash from? The bond market. Where does the demand from bonds come from? A significant amount of it comes from public pension funds. They
I
have to
mean,
park their money somewhere
yeah,
to get some type of consistent rate of interest to match liabilities. And when there's a spread above risk free treasuries that is wide enough, pension funds will take advantage of it.
yeah,
It doesn't sound like much. You get an extra percent or half a percent or percent and a half. But when you're investing tens of billions of
billions
dollars,
of dollars.
yeah,
Absolutely.
it's quite significant.
Hmm.
So the demand for corporate debt keeps climbing.
Yeah.
Therefore, buybacks and dividend increases should keep climbing, and cash on balance sheets of corporations should keep climbing,
Hmm.
and bull markets should keep going. It's all connected.
It's the most consistent graph climbing that I've ever seen.
Ever seen.
Yeah. And then the last one is the consumer balance sheets, which continue to look strong.
Yeah, consumer balance sheets just showing you over time. This is over a 25-year period of time. The percentages of really a granular percentage breakdown of liabilities, assets, the different types of assets, net worth as a percentage of disposable personal income,
Hmm.
consumer balance sheets. Again, no one talks about this enough. The economy is in great shape because consumer balance sheets are great,
Yeah.
and there is consumption because there's demand
Yeah.
and there's liquidity and ability to continue to do that. So the asset piece continues to expand and the liability piece continues to shrink.
Hmm.
That is a perfect formula for economic growth and thriving capital markets.
Hmm. Absolutely. That's
Yep.
great. And moving on, I would say that first off, that when we put these webinars together, we are always thinking of the questions that we receive from clients and individuals. And one of the questions that we have received a lot this year on is the challenge of domestic investing international, because
Mhm.
we saw a little bit of a pop, and so we thought we would address that.
Yeah, I mean, for the past decade, if you invested overseas, you got just about half the return of the US market. All the risk, half the return. Maybe you got a little bit higher yield. Um, and really, charted over 20 years, it's been the same. Um, there are many reasons for that. Number one, currency. Number two, regulations. Number three, the economic might and moat.
Hmm.
Um, the makeup of the foreign markets versus the US. The foreign markets don't have big tech sectors, they don't have big growth sectors. There's a lot of utilities, a lot of slow growth areas. Um, what you see here is just looking back over time, um, the US has a slightly higher PE ratio than most of the world,
Hmm.
but it has an exponentially higher operating margin, its companies, than the rest of the world.
Yeah.
And significantly higher sales growth, right?
Yeah.
So we tend to be more efficient, the companies in this country. We grow more, we're more profitable, and um, it just so happens that we are living in a place where we have the world's largest economy
Hmm.
with the world's reserve currency in a relatively stable place on Earth.
Yes.
So that's why the US gets a premium. It
Hmm.
always should. It doesn't mean there isn't opportunity overseas, and certainly the foreign markets can act as diversifiers. Um, but I don't see any reason for consistent outperformance of foreign
Hmm.
investing on the horizon anytime soon. There are
Okay.
pockets of it, like we've seen the first 6 months of this year, but that was primarily driven from the change in the dollar. So the
Yes.
currency change has really pushed foreign investing higher. I am not a believer that our currency will continue to weaken significantly. I think it's already been done.
Hmm.
And I think the more economic growth that we have, uh, the chances of our dollar strengthening actually go up.
Right.
So, and there are other reasons that I won't get into. It gets very complicated, but ultimately, I still don't see any major catalyst for the rest of the world consistently outpacing the U.S.
Okay.
at all. And that the catalysts we do have that exist are the foreign markets have a slightly higher dividend yield. They're cheaper,
Hmm.
but yeah, if they're cheaper, they're going to have a higher dividend yield. But they're cheap for a reason. Why are they cheap? Well, because they don't have the same operating margin. They don't have a ton of sales growth. They don't have the earnings growth that we have. They don't have the growth drivers in their capital markets,
Correct.
and their politics are different.
Hmm.
They have a volatile currency,
Okay.
and they just don't have the sector makeup that we have. So that's why we get a premium, um, and the consistency of the outperformance of the U.S. continues to demand that premium.
Exactly.
And I think we'll be in that situation for some time. Doesn't mean we're not going to have any foreign exposure. It just means we're not going to be overweight the foreign markets.
I was just going to add that and to clarify that, we have been underweight as a firm in our portfolios for the last number of years. And this little recent pop, it was not enough to make a decision to move more into international, if that's
Not
fair
at
to
all.
say. We will continue to, for the time being, to be underweight, although we're constantly looking at it and we're looking for more fundamental reasons to change that weighting.
Absolutely.
Okay, thank you. Another interesting area is municipal bonds, believe it or not, and the opportunity that we see there, just looking just at yield alone.
Yeah. Interesting chart. So I think we tell our clients all the time the yield curve of municipals is very different from the yield curve of treasuries, right?
Yes.
So this illustrates treasuries in orange versus municipals, or the tax equivalent municipal rate in the highest tax bracket, right?
Hmm.
What it doesn't even factor in is, number one, the Fed is likely going to bring rates down very soon. Number two, generally you do pay state tax on the income from treasuries. So the net yield is actually lower on the orange line. So the spread, therefore, is greater. Municipals look very attractive and will continue to look attractive for some time. And it's even more attractive than illustrated on this chart because of the things that I just mentioned that weren't priced in. So there's certainly opportunity there. And we are taking full advantage of this for our clients.
That's great. Another area that we talk a lot about is this M&A and activity and the weakness that we've seen here with the uncertainty around regulation.
Yeah, so again, very likely a second half of the year story. Mergers and acquisitions, which is M&A, bottoming consistently over the past year, year and a half or so. We think it is due for a big rise, and that rise will come through. Again, this is more of a second tier item, but that rise will come through um, more economic consistency. It'll come from now we have this bill behind us. Uh, Now we have the Fed on deck to likely cut rates, right? So
Hmm.
everything sort of gets out of the way and sets itself up for a lot more mergers and acquisitions. Not to mention, not to mention, there's going to be a lot of money in motion um, in the hands of private equity. They are very likely either going to IPO or start selling some of the positions that are mature within their portfolios, which
Hmm.
creates cash to create more M&A, right? So it's all sort of connected. And I think you are going to see a pretty significant rise in the second half of this year into 26, 27, and 28 and 29 through the lens of M&A. It is a friendlier environment than we've had in a while.
Yeah.
And I think you will see these numbers rise. And I say this because this also boosts capital markets. It boosts animal spirits a little bit, and usually boosts the economy along
Hmm.
with it. So get ready.
Another reason for optimism,
Mm-hmm.
which is great because I think you and I, Bob, in our 30 almost year careers, this is probably the one question we have always received time and time again.
Yeah. Should I invest in commodities?
Hmm.
No. They're wildly inconsistent and
Yeah.
incredibly volatile. And, maybe if you buy them and have a 20-year time frame where you won't look at them,
Hmm.
the observational risk is real.
Yeah.
Um, they do okay in, uh, you know, weird short-term pockets, but then
That
then
you
they're
can never
horrible
predict.
most of the time. Exactly.
Hmm.
Wildly unpredictable. It's really the betting markets is what it is, right? So you should never think about investing in betting markets.
Yeah.
So what you see here, though, is the reason why we put it here is if higher inflation is on the horizon, wouldn't it show up in a basket of commodities? And what you see here is sort of the 1 year view of the basket of commodities. And the only thing that's really higher, like substantially, is natural gas, of course.
Mm. Yeah.
Um, and incrementally higher is aluminum and copper. But those two are big industrial metals. So if that's sending any message, it's not inflation, it's economic activity,
Mm.
right? Everything else is negative.
Yeah.
Sugar, soybeans, wheat, gasoline, uh, crude oil, corn, coal, heating oil. Um, those are more of the used by many items, and those
Mm.
are all lower over
Yeah.
the past year.
Yeah.
And they're much lower. with the average decline being somewhere around 16%. So, and I don't see any spike up in the numbers. So, where is this inflation going to come from again? Right, right.
I have also never quite understood that when individuals get emotional and have anxiety around the S&P and investing in stocks, they want to own more commodities, and yet commodities have three times the volatility of the stock market. But
Yeah, that's like losing 10% on your Apple shares, and then you go spend $50 on Powerball tickets.
mhm. Yeah,
You're just throwing money away.
yeah,
You know, just
yep.
sit tight.
Okay. Well, hopefully
So,
everyone understands our opinion now on commodities. So
yeah.
let's move on to the economy and policy and start with the Fed, which is going to be a huge theme for the second half of this year.
I mean, we were moving pretty quickly through this one, Julina. Uh, no more.
Yeah.
So we're going to expose the Fed here to you for you. And this is a chart that the Fed puts out. We made minor modifications to it because we wanted to show you the current projection from June. You know,
Hmm.
every calendar quarter they put out revised figures. Historically, they don't revise them much, but over the past year or two, they have. And what you see here is the title line, change in GDP, unemployment rate, PCE inflation, core PCE inflation, Fed funds rate. These are all June. Then
Yeah.
we have March below it. Then we have December below it. So these Fed presidents have tinkered with this data more than we've ever seen in history. They have reduced their growth forecast. They have increased their unemployment rate forecast. They have increased their inflation forecast. And they have kept their Fed funds rate target the same. What does this mean? This means they are enabling their view to um, get the current data and force them to cut.
Hmm.
So they have modified this data in a way where they were too rigid over the years. Now they're saying, look, GDP growth is going to be low,
Hmm.
unemployment is going to be much higher, PCE inflation. So they're just updating it to be more in line with the current data,
Correct.
right? And they still have, according to their own language, two cuts in for this year.
Hmm.
We think a combination of less growth plus higher unemployment plus low inflation is going to provide more cuts. But
Hmm.
you could see if you really read the tea leaves, the maneuvering that goes on within this Fed, which is a little bizarre.
Yeah.
Um, they keep changing and changing and changing and changing. It's like, all right, enough with the talk and the tinkering. It's now
Yes.
time to cut rates.
Exactly. And I guess to be fair, they're not the first Fed to change the goalpost over time. But I think to your point, the extreme environment that we're here in, I love this visual of how they've changed Fed fund rates over the last 2 years.
Now, this is the big one. So, this is where short term rates should land. And literally for the past 20 years, short term rates, the target has been 2%,
Hmm.
right? I think everyone listening to this has heard some type of 2%. That applies to the long term short term rates, right? So the long view of short term rates and the long view of inflation,
Hmm.
right?
Yeah.
Because short term rates and inflation tend to be right around one another.
Right.
What this group has done, they have moved their long run forecast for short term rates quietly higher without really announcing it. They have done it through the written statement.
Yes.
And here it is. So from June of 2023, they had their long run short term rate forecast at 2.5. Now, if we went back a year, it would be two. But long run at 2.5, June of 24, they moved it up slightly to 2.8. And now they have their long run short term rate, overnight rate forecast at 3%.
Hmm.
So we have rates right now, short rates of 4.5%. That means to meet their long run short term rate level, the Fed will have to cut rates by 1.5%. That's six cuts.
Correct.
Six cuts they are saying they're going to lay out over the next 18 months.
Hmm.
That makes sense?
Absolutely.
So
Which
there's some cutting to do, Julina, is
there,
what the Fed is saying.
yeah,
Right. But amazing how this didn't really make any headlines. To move your long range short term rate forecast
yeah.
up from 2.5, really from 2 to 2.5 to 2.8 to 3,
Hmm.
you would think this would be a big deal.
Right.
They did it this way, so it wasn't a big deal. They hit it.
They hit it, yet the market is expecting it.
Yeah. So now the bond market and the stock market, they're pricing in the reality of, hey, that's nice that you did all that hidden stuff, but we still think you're going to cut a lot more than you're saying.
Sure.
And here is the implied number of cuts looking out just about the same 18-month period of time.
Hmm.
And you can see there are quite a bit of them being priced in and very likely more coming.
Absolutely.
Yep.
And what about global rates and the world relative to the US? It's interesting.
Yeah, we shouldn't have the highest rank, the highest yields amongst, the developed nations, and we do right now.
Hmm.
So what does this say? This says the Fed needs to get with the program because just
Hmm.
about everybody else has lower interest rates than us, and you want to have more of a competitive environment for our businesses and our consumers.
Absolutely.
Yeah.
And through all this, the economy continues to grow.
The economy continues to grow with the Atlanta Fed forecasting about a 3% rate of growth. Hold on to that number in your head. We're going to address something later in this presentation.
Absolutely. So that number, the estimate is 2.9%, correct?
Mm-hmm. Yep.
Okay. Yep. And so let's talk about tariffs. Is this conversation over?
Oh, the places you'll go. It's almost over.
Yeah.
But you could see over the past, let's call it 4 months or so, where the levels have gone
Hmm.
and the headlines and the tweeting and the changing and all that stuff. And ultimately, I think we're going to land somewhere closer to 10%,
Hmm.
which is where we were, about 3 months ago.
Sure.
So all of that emotion, all of that market carnage, all of the movement of people selling stocks they shouldn't have sold to get to a point where tariffs will probably land somewhere at 10%. It's almost over. The drama is almost over, at least when
Yeah.
it comes to tariffs. Um, and we just put it in here to show you how
It's settling
wild
down.
this ride has been.
Yeah, absolutely. I think, going back to the topic of interest rates and looking at the cost of our debt due to where we are, it's staggering to see the numbers.
So this is really just focus on the red line. It is government interest costs as a percentage of tax revenues. So of all the tax payments that we receive, just going back 3 years, 2 years, the cost of government debt, so the interest on our government debt, was about 4% of all income tax that came in.
Hmm.
Right
Yeah.
now, it's 10%. Why? Well, we're receiving more tax revenue, significantly more tax revenue, but the rate on our debt, the interest rate on our debt, has risen significantly.
Yeah.
Right, almost a double.
Absolutely.
And that has created a double in the interest expense category.
Hmm.
Now, the Fed, who has two mandates, might need to have a third mandate, and that is helping the government find a fair rate of its debt because interest expense is out of control directly due to changing interest rates of the Fed,
Hmm.
right? Which
Yes.
is why the president is screaming at the Fed. It's like, listen, what are you doing here?
Absolutely.
We're charging ourselves too much,
Hmm.
and we can control it. So let's control it.
I think even the better visual of how much we're charging ourselves is on this slide, looking at the net interest.
Yeah. So the past 5 years, the change in expenses, right? Change in budget expenses. The big increase, forget the percentages, the big increase is interest. It has risen by just about $500 billion per year
Yeah.
from a level of $500 billion. So we have a double.
Hmm.
Nothing comes close to this.
Yeah.
So again, you can see why rates should be lower and need to be lower.
And when you say nothing, you can add up Social Security and health, and it still doesn't reach the number on the net interest.
Correct.
Staggering.
Yep.
Yep. All right, so let's talk a little bit about inflation and where we are.
It's low. Yeah.
Yeah.
You want to go to the next slide?
Yep, absolutely.
Okay, great. And the 2 year, 5 year, 10 year, 30 year break even. So the this is where the bond market has inflation. Um, it's been a while since we've seen it this anchored.
Yes.
So whether it be short, intermediate, or long term inflation, the bond market has it priced in somewhere between low twos to mid twos.
Hmm.
So it's like, okay, Fed, what are we waiting for again?
Yeah.
And the bond market is right often,
Right.
certainly when it comes to the direction of inflation over time.
Which is why it's always so intriguing when the bond market is all speaking the same language,
Yes.
right?
Yeah, the
Uh,
Fed is nearing a policy mistake
yeah,
by delaying this.
absolutely.
Yeah.
And so when you look at it relative to housing, you've got
Direct impact.
there you
So you have home sale price
go. Hmm.
not rising. Year over year change in medium US home sale price.
Hmm.
There are some transactions happening, not a ton, and prices are not increasing,
Hmm.
right?
Yeah.
Um, a lot of that has to do with mortgage rates. A lot of that has to do with finance costs from all other forms of life, like autos, credit cards, all that stuff. So I think, the Fed, by keeping interest rates high for a longer period of time than they should,
Hmm.
they are draining the consumer a little bit, which, in turn pulls down inflation, but it pulls down the economy, the thing that they would have to rescue
Yes.
if they make the wrong move. Um, and the nice thing about housing is it's a third of the inflation calculation
Hmm.
and it's delayed 18 months. So I believe the big negative anchor in inflation for the next year or so is going to be housing. I do think there will be much more housing activity coming within the next few quarters or so. But again, that won't show up for a year or two,
Right. It's
right?
delayed.
Yeah.
Yep.
But I do believe the inflation data that we look at, that is stale, mind you, is about to get a deflationary wave from housing because the real estate market is not the the 2021, 2022, 2023 environment. It
Sure.
is much cooler.
Okay.
And to see that, just look at Florida.
Yeah.
No one is paying over ask.
Okay.
There are lots of condos for sale and there are lots of declining prices happening. So,
Absolutely.
yeah.
We talk all the time about how the Fed has two mandates, the first being inflation and the second is unemployment.
Mm-hmm. So this is sort of the Warn Index, which really just factors in more than delayed data, factors in some live stuff, and then it reruns itself sort of fast forward on a 2 month basis. So long story short, this Warn data shows that the unemployment rate is going to rise.
Hmm.
And again, one of the two mandates of the Fed, uh, inflation, keeping it low, and unemployment, keeping it at a full employment level.
Hmm.
You're about to see a spike in unemployment. A lot of that has to do with some subtle layoffs plus government layoffs and the non hiring of government. And this quarter, we are very likely going to see an unemployment rate that hits that 4.5% that the Fed is expecting. And that's another feather in the cap of cutting rates, um, certainly for September, potentially for July.
Lots of reasons for them to do it, right?
Yep. Yep.
We have another slide on jobs, but really looking at it in regards to AI, which I think is so interesting.
Yeah. I mean, look, these charts are, you got to look through them sometimes. So ultimately, you see less employment, right? And less employment sorted by sector and style, right? Type
Hmm.
of job. And what you see there is potentially the effect of some of this artificial intelligence mixed with the over hiring during the COVID years, right? You couldn't hire anybody. Um, you allowed everyone to work remote, even though they should be in the office. Now, a
Hmm.
lot of these companies are laying some of these people off. So, it's rebalancing the employment setting, where they were, probably employing too many people, and some of the positive effects of artificial intelligence, which creates more productivity, which creates more economic growth, which creates more efficiency, which creates higher corporate earnings. Anyways,
Mhm.
there's that.
Absolutely. Yeah,
Yeah,
that's great. And the last point we wanted to make on the economy and policy is the big, beautiful bill.
it's a done
We
deal.
haven't, yep.
It's a done deal. It was signed on 4th of July. And, what we put up here were some of the key changes. And most of the key changes were just extensions from 2017, right?
Mhm.
It would have been horrendous because if we didn't extend this bill, we would have had the biggest tax increase in history. I don't know how anyone could be for that. So we have in essence an extension, with some modifications. The changes are really to no tax on tips, no tax on overtime, again, up to certain levels, an enhanced deduction for seniors, for 3 years. You have no tax on car loan interest up to $10,000 for cars assembled in the US. And this is for years 25, 26, 27, and 28. So
Mhm.
I guess a good question is, what about the German BMWs made in America?
Right.
Right. I'm going to assume because it's made in America or assembled in America, you got to really look at the language that it will
Mhm.
qualify. So more to come on this stuff.
Yeah,
And then again, the probably the most popular modification is the salt cap,
right.
and there is a move from $10,000 to $40,000 for 2025. 2026 will be the same. 2027, 8, 9, and 30, there will be a 1% increase, but there are income limits and other phase outs. So this one's not that straightforward. So it's a very good time to have a qualified accountant on your side, to help you with this laundry list of small tweaks that we have here. There are many more pages to this in the presentation deck that will be included in the link. We will put more of this data for you to see. I know it's hard to see. We'll put them all in here because there are some key business changes,
Right.
and some other energy changes as well.
Yeah, there's a
So
lot in there. Absolutely.
yeah.
And I know you wanted to make one more point about the bill in regards to the CBO.
I didn't want to, but I think we should. So you hear about the Tax Foundation, the Heritage Foundation, this foundation, the Princeton Tax Foundation, the UPenn Tax Analysis Group, and the CBO, the Congressional Budget Office. None of them ever get it right. They're always way off. They're trying to be super conservative,
Mhm.
right?
Yeah.
And the argument with this bill is it creates a bigger, more debt and a greater deficit. Well, does it though? Because anything that these foundations and the CBO calculates, they don't really forecast things so dynamically, right?
Hmm.
The impact of this in the future, so on and so forth. They just take some basic stuff and add a growth rate to it.
Right.
The growth rate that they use for the economy is 1.8%, which I think is ridiculous.
Right.
If you use such a low growth rate for our economy, well, of course it's going to look bad. Doesn't matter if it's Republicans or Democrats. If you use a realistic rate of growth over the next decade, then technically there isn't even a deficit or an addition to our debt.
Hmm.
So why am I making a big stink about this? Well, if we look by decade at real GDP growth, the only other times we had growth in the ones was number one, the decade of 2000, when we had the tech bubble implosion and the great financial crisis tied together in the same decade. Even then, it grew greater than what the CBO is forecasting over the next 10 years. It grew at 1.9% for the decade. CBO is using 1.8 for the next decade,
Right.
right? And honestly, that's as close in the modern day as we can get to a depression, the tech bubble implosion, and then the financial crisis back to back.
Yeah, and we continue to talk about the strength of the economy
Yeah,
and
exactly.
consumers.
Right. Yeah. So it's silly. And then prior to that, the only time it was lower than 1.8% for a decade and this one might ring a bell, is the actual Great Depression.
Hmm.
So coming out of 1929 into the 30s, where you just had a horrendous, it defined a whole generation, right? The
Correct.
Great Depression. We still had positive growth. It was 1% annual economic growth,
Right.
right? So that was the only time that it was below this 1.8%, and it was still positive.
Exactly.
So the CBO must think we're in for a depression over the next decade, one similar to the tech bubble and great financial crisis decade of the 2000s to get to 1.8. The answer is they don't. They're just using a very conservative number, right?
Ridiculously conservative.
Ridiculously conservative. If they just used a normal number, let's say 2.5 or 2.8%, 1% higher, you
Hmm.
literally don't have any more debt or a deficit from the passage of this bill, right?
Exactly.
Um, and the CBO doesn't even forecast non congressional activities like tariffs. There's quite a bit of revenue coming in from tariffs that is not even forecasted to offset any of this.
Right.
So there are other, positive business initiatives within this bill that are pro economy, that also aren't scored properly. So the CBO, if you're in our industry, you have to understand is a joke. They never get it right. They never get it right.
Well, and I think that this is a great way to sort of end this piece of the webinar because we're going to continue to hear about this through the media if you
Mhm.
don't understand the dynamics of how it works.
Yeah.
Okay,
So,
thank you for going through that.
yep.
This is where we're going to transition to the everything else, and we have some slides that we're excited to share with everyone.
Oh,
And
we're so
starting with
excited.
stablecoin.
We're so excited to talk about stablecoins. So, in order for cryptocurrencies to be more transactional for, you know, normal everyday activities, there has to be a stable pot, almost like a money market,
Mhm.
for your cryptocurrency. Uh, Hence the name stablecoin.
Mhm.
So there is a market for this stuff, and it's an increasing market. And recently, this year, there was a bill that got passed that approved the stableness of stable coins, very similar to how banks are regulated.
Yeah.
Their money, excess reserves, have to be parked in treasuries. Sounds like a bank. Well, it's setting up that way. Well, what does this mean? Well, it means that there's potentially over the next handful of years trillions of dollars that have to roll in to treasuries because of the passage of the stablecoin bill, uh, that will stabilize these stable coins,
Mhm.
right? So we talk about, you've probably heard in the news, China not buying as much of our treasuries, our debt, as they have in the past, and the same thing for Japan and incrementally others as well. Well, that's okay because if stablecoins have to place their reserves in treasuries, we
Right.
don't need any of them.
No.
There's so much money that is going to roll into our treasury market,
Hmm.
just through the lens of stablecoins. It's almost like recreating another banking sector all over again that has to have stable reserves, which are treasuries,
Hmm.
right?
Yeah.
So, what could that do? Well, that could actually send short, intermediate, and long term rates lower
Right.
because the demand will be there. Not an unlimited amount of demand, but an increasing amount of demand. And that could bring rates down.
Exactly.
So, more to come here.
Yeah.
The reason why we're mentioning it, but we think it's something that not enough people are talking about, the impact of the reserve requirements of stablecoins
Yeah.
and the impact to our yield curve and
I
what
I
that could do.
Yeah, I was just going to add, it's amazing to look at this slide to see how it really grows in periods of uncertainty. And I think we're big believers that the markets will always be uncertain. And you go through
Mhm.
these periods, and that's going to be quite an opportunity there.
Absolutely.
And what about all this conversation around AI and its impact on businesses?
Yeah. So you what you see here is a list of all of these large language models, the chat GPTs, the AI platforms of the world. and their efficiency and their processing power and how effective they are, how accurate they are. And what you see here is most of them are more effective and way more efficient and a lot cheaper than hiring a PhD in their field. And this is applied to any sector and subsector. So just about all of them blow away any PhD in their field. So what does that mean? Well, I think it means that the cost of doing business is going to drop, efficiency is going to rise, and the educational institutions of this country and the world will have to modify what they are teaching to our kids and grandkids.
Mm-hmm.
This is going to have a pretty significant effect in the coming decades,
Right.
if not sooner.
And this slide is showing an 82% drop in cost from just 2 years ago.
Just 2 years ago. You're absolutely right.
Right.
Wild.
And let's talk a little bit about electricity and the correlation to the topic.
Yeah. So, I mean, we have electric cars and we have electric everything. We plugging everything into the grid, thinking that it's cleaner.
Mm-hmm.
It's not. At the end of the day, we are just demanding more electricity, and electricity primarily comes from natural gas, and then coal, then oil, and then renewables, and hopefully soon nuclear. Because if we don't get that nuclear, we're not going to have any power. We can plug in all we want, nothing will get charged.
Mm-hmm.
And maybe we should start stocking up on candles, right? Is Yankee Candle, is that still a store? Maybe we should buy
Uh-huh.
the Yankee
Yep.
Candles up in America.
Right off
So
91.
yeah, right. So ultimately, we're going to need a lot more power, all sorts of power,
Yeah.
because there's demand for electricity. So we invest in this directly in our client portfolios through, you got to look through the overlying investments that we have to get the
Mm-hmm.
granular holdings that we have. But there's a big demand for power, and there's a huge opportunity in the investment world to invest in this stuff, of which we have exposure to, and it will likely increase over time.
Yeah.
We're just getting everyone ready for these headlines because we're using more technology. Cars are using more electricity. Homes are using more electricity. Um, Whenever you hear going green, it tends to be not off the grid. It tends to be grid transformation
Mm-hmm.
from dirty energy to cleaner energy. But it usually morphs into just more electricity demand, which is
Right.
wild.
We're coming off the 4th of July holiday, and I hosted my family over the weekend. There was 10 of us, four teenage girls. You wouldn't believe the number of power cords that were in my house in
Right,
every single room.
right, right. Yeah,
So
it's amazing.
picture that.
Yep.
Let's quickly talk about the political landscape and how it's shifted.
Yeah, so this is interesting, right? It's showing you the makeup of Congress. So the 96th Congress versus the 118th Congress, which is the current, and how this is really measured by the proposals that they put out there and how they vote and the bills that they bring up. What you see is there is no representation in the middle. I mean, there is a Grand Canyon in the middle, right?
Massive.
Which is where most of the country leans.
Mhm.
So when you think about why we're so divided, my answer is it's the politicians. So is the political parties that force the politicians to bring up and talk about certain things,
Mhm.
and the media who amplifies certain things.
Mhm.
And none of it's good. We need the middle to show up
Mhm.
because that's where most of the people are, and that's where most of the votes actually are, right?
Absolutely.
Um, so don't blame your cousin, your crazy cousin, or your crazy uncle, or your crazy sister for saying things that they say or acting the way they act. Blame the politicians, right? Blame the political parties and the media
Mhm.
for forcing this on us.
Yeah.
We are just getting more divided through the lens of bills and the people that um, write them and pass them. Hopefully, when we hit the extremes, we converge back to the middle. But I think we got a little bit longer to go. Boy, is it needed.
It's so unfortunate. We've been saying for years, how much more polarized can we get? And unfortunately, we've leaned even more. So, and we joked earlier about how in our careers we have these questions that never go away, international investing, commodities, and then the other big one is the dollar and the future of the dollar.
Boy, oh boy, we've had this conversation for 30 years, Julina, and every year the dollar is not going to be the world's reserve currency. What happens
Mhm.
when? What happens if? Blah 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 blah.
Yep.
Nothing has happened.
Yep.
This is the dollar's dominance, right? And I know that chart looks like it's decreasing because it is ever so slightly, but not by much.
Right.
It's funny, we only hear the talk of, well, what if the dollar loses its dominance?
Right.
And no one ever says, well, hey, the next most used and trusted currency would likely be the one that we default to, right?
Yes.
And Julina, do you know which one that is?
I didn't know until I saw the slide. The
It's the euro.
euro.
The euro. Poland doesn't want to join the eurozone. The UK is like, listen, we were part of the eurozone
Yeah.
for a little while, but we kept our own currency. We want to have nothing to do with the euro.
Yeah.
So wait a second. So your people are fearing if we don't use the US dollar, we're going to use the euro?
Mhm.
You got to be kidding me,
Right.
right? So take a step back, take a breather. That's not happening anytime soon
Mhm.
in our lifetime. And if you're questioning where the Chinese currency is, the renminbi, it is in gray up top.
Yes.
But it's also mixed
It's
together with the
included with
Canadian
everything
dollar.
else.
Yeah, Canadian dollar and the Australian dollar.
Yeah. Fair. Yes.
Right. So that this is what makes up that group.
Mhm.
Now, this is simply through the lens of foreign central bank reserves. So this is just simply a view of all of the foreign economies with their excess cash,
Excess cash.
right? What do they do with it? This
Mhm.
isn't a view of the world's money. This is just the excess cash of foreign governments.
Mhm.
Even they take about 58% of it and park it in US dollars.
Right.
And they have some euros, and they have some gold, and they have some yen, Japanese yen. They have some pounds. They have some other stuff. This is just the through the lens of excess reserves. It's still high.
It is still ridiculously
Never
high.
mind the percent of global transactions that happen in dollars,
Hmm.
right?
Yes.
The amount of wire transfers globally that happen in dollars,
Hmm.
the fact that commodities are priced in dollars,
Yes.
all of them,
Hmm.
right? So this is on the wall of worry. Take this one off.
Correct.
Yeah.
But we'll still continue to get the question.
Yep.
Yep. So we wanted to end as we have in the past on a good note. You and I practiced the pronunciation of this Japanese concept. I'm going to try and say it right. Ikigai.
I don't think that's right, but that's a nice try. But we'll go with that. So, isn't it Ikigai?
Ikigai.
Yeah.
Ikigai. Go ahead. Okay. Yep, that sounds right.
Anyways, right.
All right.
So there should be more time spent focusing on this stuff by all people, us included. Um, really, it's a Japanese concept for a reason for being, right? And if you spend more time, at least through the lens of a career, um, focusing on what you love, what you're good at, what you can be compensated for, and what the world needs, where there's a need, you get things like a profession and mission and passion and vocation. And the more of these you connect with, the more meaning you have, the more purpose you have, and the better you feel, the happier you'll be. And potentially the more successful you'll be, the more at peace you'll be. Um, and we bring this up because there's just people that are just upset everywhere, more so than we've ever seen in history, globally, right? Focus more on this, at least when it comes to, um, your profession and life in general, find balance through doing what you love, what you're good at, what you be compensated for, and where there's a need, and things will be okay. That will occupy enough of your time in a positive way to overpower all the negatives. Number one. Number two, if you're thinking about retiring or have retired while working with us, we hopefully are trying to coach you, have coached, or continue to coach you through retirement. And the big issues, certainly if you're a client of ours, usually aren't financial. They are finding a new purpose, um, or learning new things so you become good at them, and or working part-time or consulting so you can be compensated where there's a need, right? So it's you got to recalibrate your mission, and sometimes the process of recalibrating is not easy and
Hmm.
stressful and confusing, especially at a time where your paycheck goes away. So I think the more you focus on this and the more aware you are of this stuff, the better you will be, certainly as an investor, certainly as a person, and definitely as a retiree. So that's why we put it up here. We like to end these things on a positive note all the time because there's way too much negative out there.
Hmm.
So let's take the other direction and go with it.
Absolutely. Find your Ikigai, J.
Sure. Find your whatever you want, we'll call it.
Thank you. Well, Bob, as always, we appreciate the insight. Looking forward to the next monthly webinar. But I think as you and I have talked a lot about on these webinars for this year, we are expecting a lot to transpire in the second half, but yet we remain very positive on the long-term outcome.
Yeah, mostly positive stuff that will play out. The setup is good. The foundation for a bull market and an economic growth is there, as good as we've seen it. And again, the wins of having more consistency, less uncertainty, more certainty, lower interest rates. The second half of the year will also benefit from less regulation or changing regulation. We've got some good things in the pipeline. We are super optimistic. There's a lot to be thankful for, and we are lucky to be here, and everyone should also feel lucky to be here. We have it good. We have good clients. Our clients also have it good. They're with us, of course, and we appreciate them and all they do to support us.
Yes,
Great.
absolutely. Yeah, we appreciate it. And as always, if anyone has any questions, please feel free to reach out to us. We're here.
We'll see you in a month.
Yeah. Thanks, Bob.